I'm Mohamed, one of the partners at CoPilot Tax. We're a tax firm or an accounting and tax firm focused really on proactive planning. So what I found, through my years in tax is a lot of times your accountant really isn't thinking about how to save you tax.
Mm.
They're kind of just doing the returns, not really putting much thought on planning, tax planning, just general financial planning. What I wanted to do is start a firm with my partner where we proactively think about that. It's not up to the client to really come up with the ideas and us to think about, oh, does it work or not? It's really on us to actually come up with the ideas to the client and be like, hey, would this be suitable? This kind of fits your goals. That was the background behind why we started Copilot Tax. We've been operating for about 2, 3 years now. Things have been going good. Get most of our clients for Twitter, so if you don't already, or X, whatever you call it these days.
Nobody calls it
Uh,
X.
I don't think I've heard anyone call it X. So follow us there, Canada Tax Guy, and soon and surely other platforms, TikTok, YouTube.
That's pretty cool. I've seen you on TikTok with your previous brand. I loved what you were doing. It said, you know what? If he's on TikTok, I got to be on TikTok. I got to start doing videos. It pushed me in that direction as
Yeah, you
well.
called me out on one video actually. I loved it.
I called you out. No, I was actually more or less agreeing with you 99.9% of it. I think I was just adding a little extra to what you were saying. I loved the format you chose where someone who made just $5,000 additional in 1 year of revenue, let's say getting a part time job on top of their full time job, can be taxed at like 60% when you consider Canada Child Benefit, when you consider other tax credits, and in reality they're being taxed a lot more. So that was an excellent way of delivering what you as a proactive tax accountant CPA can really do for your clients.
I appreciate that. No, and honestly, that's a part of that finding was actually from reconfiguring how I think about taxes and the financial planning and investment advising community, which looks into these benefits. A lot of respect to them and those organizations.
Yeah, I know they're amazing people. I think they're helping us go into the right direction when it comes to making financial services, financial advisor profession a real profession with standards and ethics. Thanks to all those at FPAC if they're watching. I wanted to pick your brain. Few questions, nothing crazy. No questions about money laundering for my best friend. Uh,
That's what I've prepared for. You're gonna catch me off guard now.
so, look, it's November as of time of recording, and I hope everyone's watching this before 2025. Both advisors or their clients, Canadians in general, should be doing now before December 31st.
Wow, that's a great question. So one of the things we do is we actually reach out to clients, check in with them. We have an annual tax review closer to the end of the year, where we re-engage, find out their facts, any changes, and identify tax planning opportunities before the year ends, and also for the upcoming year. So one of the big things, for instance, which is a common discussion typically in February, is RSP contributions, if you should make an RSP contribution. That's something we look at now rather than kind of leaving it last minute to in January and February
Hmm.
when it typically happens. If you have a corporation, we look at compensation planning for this year and the upcoming year. So are you going to pay yourself salary, dividends, those sort of things for the upcoming year? So it's really just making sure you're engaging with your accountant, your planner, whoever, and making sure you're checking all the boxes for tax planning this year and proactively looking at the upcoming year as well.
Hmm. You mentioned something important here in the earlier, and that was RRSPs, right? Waiting. Here's I had this written down. Underrated or overrated RRSP season. What's your take on
Uh,
RRSP season? I have my own opinion on it.
Everyone says, should I be contributing to my RSP? Really, that decision should be coming kind of before February, right? It's not a decision to only make in February. It's actually a decision you can make throughout the year. So, I don't think there should be an RSP season, but just because of the nature of people get busy. They might have, forgot to make contributions. They might not automate these things, which, kind of causes delays, causes setbacks. There is a RSP season just because of the reality of our schedules and everything. So I don't think, ideally there shouldn't be one, but the reality is there tends to be an RSP season.
I find the only real demogra well, not I mean, come on, this is sweeping statement, right, only. No, but I find that the people who do need RSP season are, I would say, in my view, business owners because income is sometimes unpredictable, and so you don't exactly know what you're gonna really get until it's end of the year and after the end of the year. Also, people who receive bonuses, perhaps, so like then an RSP, an RSP contribution late, well, as in, towards the first 60 days of the year might seem like a good idea.
I think that's a fair point. I would kind of just extend it and say there's not many people are really analyzing how much they're making during the year. They only do that maybe once the year ends. They'll look at, this is how much rental income we made or whatever the case is. So I think because you don't have that kind of proactive approach to, analyzing your income or knowing how much income you make, it could bring up those situations. Kind of like you mentioned, people who get a bonus, which throws off projections, or business owners, which, they don't always have stable incomes. I think that could be one situation. People who are not aware or don't have a good hold of how much income they're going to make until after the year finishes.
A thing I wanted to ask is RSUs. Lately, I've been getting a lot of high income earners reach out to me as clients. They're like, I get paid in RSUs, but I'm not entirely sure how they work. How are RSUs taxed?
I'm glad you asked me this. I have a whole video coming on this and a whole article, and it's actually there's not a lot of good articles on this and not a lot
No.
of good information. So RSUs are essentially, like, to keep it simple, just shares of your employer as a form of compensation. And there's a couple things to be aware of. First of all, it's the vesting schedule. Well, I guess before that, how do I say this? There are a couple things to be aware of. Okay. The first thing is how it's structured. So you usually get RSUs on a vesting schedule. So you might get 10
Mhm.
this year, 10 the following year, 10 the year after. Typically, you get taxed once it vests. But in
Okay.
some situations, when granted it, you could be taxed on the full amount. So instead of 10, 10, 10 over 3 years, you're just taxed right away on 20, right? And
What?
yeah, it leads to some not so great tax situations. So I think first of all, you need to find out, are you taxed on vesting or are you taxed on grants?
Mhm.
The second thing is if it's a single trigger or a double trigger. A single trigger is one condition needs to be met versus a double trigger is two conditions need to be met in order for
Okay.
you to get RSUs. So a big public company might just have vesting as one requirement. But some startup might come in a situation where they say there's a vesting period, but you don't get entitlement to these shares until the company goes public or until the company sells,
Mm,
right?
mhm.
So that's really good because you don't get taxed on it until the company goes public. So if you have, a startup that's giving you single trigger RSUs, so just RSUs that vest, but there's no liquidity requirement or anything like that, then you're going to get taxed on that and you won't be really able to sell it because it's not a publicly traded share. And so
Mhm.
your one client ran into the situation. Their startup is issuing single trigger RSUs. They're paying a whole bunch of tax and can't really do much with the shares. So they're just stuck with a whole bunch of tax and illiquid shares, right? So that's the second big thing to capture. Those are the two main considerations. There's quite a bit of tax planning that can go in here. It's not well known, you know, these kind of things. The biggest thing is, you're usually pay the tax. Let's say they give you 10 RSUs and your tax rate's 40%. They will sell RSUs, use the proceeds to pay the tax. So you get net RSUs of six RSUs, right? Six
Mhm.
shares. And then the one thing to keep in mind there is that let's say you already own a whole bunch of RSUs at a much lower value, much lower
Yeah.
cost base, right? Then that sale, because you average out all the shares you own, that sale could trigger a capital gain you might not be aware of, right? If you own like tons of shares at a lower tons of that same share at a lower cost base, and then you're getting new RSUs at a higher cost base, and they're selling it, then because the cost base is being averaged out, there's actually going to be a capital gain on the sale to withhold on your tax. And so there's
Mm.
actually some tax planning such that there's no capital gain when they sell. when they sell the shares to withhold on the tax. So there's actually, it's not, you know, people kind of talk about RSUs as a simple thing. It's not really that simple, and there's actually quite a bit that goes into it.
When do you think that article will be out?
Hopefully in December, but it could be January. There's a video coming out too. The
Awesome.
article's already written.
Will the article be published in a magazine, available in PDF, or
It's
on a
just going to be on our.
newsletter?
What do you think about RSUs and the feeling people have towards the shares of of their company, of their employer?
So RSUs, in my view, I'm very much neutral towards the concept of RSUs. The problem I find with RSUs isn't themselves, it's just how the client tends to somehow have a weird behavioral attachment to it, like a weird emotional attachment to it. So oftentimes people will accumulate RSUs and just, not diversify that risk. And this leads to several problems. You get the one where now you have all your eggs in one basket, or a large portion of your portfolio in that basket. And that tends to often that can really get a real downturn, on the share price, and the person still won't sell. And then even if that's the case, they won't sell thinking it will go back up to where it was before. That's not a guarantee. I mean, it could, but it's not a guarantee. And then not executing a capital loss on some shares in order to, well, if you think it's going to go up, at least you can offset the capital gains, right? If it does, but you're also shifting money away from a concentrated position and putting it in a more diversified basket, like an all-in-one ETF or something. Hashtag not investment advice.
By the way, everything I said, not tax advice.
But yeah,
Just letting your audience know.
so that's my issue with RSUs. It's an interesting, often a tax efficient incentive for the client, but it creates dilemmas that often will lead the client to a paralysis in making a decision. And then, boom, you have $50,000 worth of shares now worth, $20,000. I had one client who had shares from a previous company, and they went down to 20% of their price when vested.
Ooh, oof.
So yeah, I
Yeah,
told them we looked at their situation. They were at a new employer getting RSUs. And we said those RSUs are going up in value, vesting next year. Just sell your old shares from your prior company to lock in a capital loss. Like it wasn't going back up.
makes sense.
That's the issue with RSUs.
Yeah, I can imagine there's a bit of a emotional attachment because they probably think their company they're working for their company, so they probably think the company's gonna do well.
Yeah, and that company could do well, but it's not up to the company to decide their share price. It's up to the market, and the market may not perceive it. You could be part of one of the best companies, and if the market is not seeing the value, what are you going to do?
What if the company doesn't do well, but the market perceives it as doing well? How do you counteract that argument?
The issue is, will the market perceive it as doing well? Since we can't answer that, you have to limit your risk exposure. Even when things are going well, look, if you think they might go well in the future, then look, just choose a portion of it that you would say, hey, if everything went south, I wouldn't cry over it. That's a portion you keep. The rest you should diversify. And it's just better off, that way. Also, better off to maybe, let's say you do sell it and lock in a capital gain. Think about it. If your career trajectory is going up, so let's say in the next 5 years, you're going to make more money, it might be better to have a capital gain now than in the future.
Yeah,
You're protecting the upside on having to pay more tax.
makes sense.
What are some of the most overlooked strategies for tax savings? I've heard not enough people donate shares to charity. Instead, they liquidate the shares that make the donation. Are there
That is
other things like that?
that's definitely a thing. That's actually quite common. I think it depends on what group you're talking about. If you talk about the general population, just taking advantage of registered accounts, majority of people probably don't even know what that is, not taking advantage of it, or don't know how to invest. Taxes is one thing, but investments is another. Taxes are important, but investing is probably more important. You need the basics done first, and I think that's the biggest thing. But when you
Mhm.
get into more complicated situations, I think donating publicly listed securities is big, especially for high net worth people. I think when you deal with business owners and people who are incorporated, just the compensation, the way you pay yourself from the corporation, there is so much money that's being left on the table from that, and it's
Mhm.
insane. It ends up being one of the biggest discussion points with our clients, just because it's not being optimized. In some situations, they should pay salary. In some situations, they should pay dividends, and they're not doing that. They might have a mix, but it's not in the best optimal mix. And I think that's probably the biggest one for business owners, just making sure you're paying yourself from the corporation correct
Mhm.
information. And that might be, investing in your corporation rather than investing in your RSP.
Yeah.
Or a big one is people own rental properties and they're not claiming depreciation. I just had a big argument with my client this morning, insisting he claims depreciation on his property. And there could be some situations where you don't want to claim depreciation.
Yeah.
His facts, it definitely makes sense. He owns like 8 rental properties, and I'm trying to get him to claim depreciation. He's paying a massive amount of tax each year.
If he
Um,
claims curiosity about depreciation, right, you can't claim depreciation on your primary residence, but you can claim a portion if you own, let's say, like a duplex and you live in that duplex and you rent out the other one. But isn't the argument against depreciation that if you sell for a capital gain, you owe that depreciation back?
so if you sell it for more than the undepreciated value, yes, you have to pay that depreciation back. There could be situations where that doesn't make sense. If the depreciation, the value of the depreciation you're getting is at very low tax rates, and then when you sell, it's very high tax rates. Like it might not make sense. In this situation, he's already at the highest tax rate, and just because you pay it back, it doesn't mean it's not beneficial. So you're still deferring tax,
Mhm.
and deferring tax doesn't just mean not paying tax one year and paying it in another. There could be a monetary benefit. This surprises people when you work through the math and see how deferring tax can make you more money. It helps you with kind of understanding the benefit. A big one is like RSPs. People don't like to invest in RSPs because they eventually have to, pay the tax. But the value of deferring
Today.
tax is
Yeah,
insane.
exactly. I find the whole, and as you and I can attest on Twitter, there's always someone in a thread saying RSPs are a scam.
They're a scam for the government, not being able to collect that much income for you, but for the regular citizens, regular residents, it's a pretty good tool.
So claiming depreciation on a property is usually a smart thing to do. I have to look at it on a case by case basis, but general terms, it could be a smart thing. And not enough people do this.
You have variability. In some cases, it might not make sense. It's case by case, but in some cases, it does, and people still don't want to do it. One of the main reasons is people don't like paying the tax when you sell the property.
That's a tomorrow problem.
Exactly. And it's not like they have any, if they're planning to sell the property in 2 or 3 years, I can understand, but it's not like they're even doing that.
Hmm.
Premature incorporation is one of the biggest things. Everyone hears about it, especially doctors. They hear about incorporation right when they graduate, not graduate, right when they finish residency. It's like almost instant.
Yeah.
And I think there's some things to think through before you do that. Number one is, what are you going to prioritize paying down your debt? Are you going to prioritize, investing, but you're going to have some debt? Are you going to prioritize paying down your mortgage? Are
Hmm.
you going to invest in securities? Are you going to invest in real estate? How much RSP room do you have? How much TFSA room? I think there's a lot of questions you need to ask before. How much do you spend? The biggest one, obviously, how much do you spend? How stable is your income? How much do you make? You need to know the answers to these questions before you incorporate, because it might not make sense to incorporate. If you're spending all the money you make, it might make sense to never incorporate, depending on your situation. The way I approach it is, first, what kind of personal debt do you have? And do you want to prioritize that? Second, are you interested in investing in real estate or securities? If they're interested in investing in real estate, generally it lends to kind of incorporating a little quicker. When you're interested in investing in securities, then you have other vehicles, right? You have the TFSA, you have RSP, which you can kind of take advantage of before incorporating, or you don't have to incur those expensive incorporation costs, accountings, and legal fees each year to have a corporation. You can kind of just make use of your RSP and your TFSAs until those have been maximized and you're still generating more income. And if there's a huge delta, depending on how much the delta is, then incorporating can kind of make sense.
Yeah.
I'm
Yeah.
actually a person who incorporated prematurely, and I knew the rules. I think it's just a habit. When you hear other people, especially like when you hear other people in your profession doing it, you just feel like, oh, I should be doing this. It makes no sense why I wouldn't be doing it. I knew it didn't make sense for me, but I still did it.
Mhm. Another for business owners, let's say incorporated business owners, many want to do real estate. I'm neither for nor against it. They feel they have to own the real estate in their corporation. That would cause passive income clawbacks on the small business deduction. So, what is the rule on that for a business owner to own properties as an incorporated business owner?
I think in the corporation it could make sense. The passive income grind of, 50,000, which starts at $50,000 of investment income,
Mhm.
it's not as bad as, as it's made out to be because of integration and everything. And, Ontario also has these special rules which make it not so bad. And it's one of the few, there's I think two provinces, one of them is Ontario, which has these kind of special rules. The second thing is when you own a rental property and you have depreciation available, it minimizes the amount of rental income you report.
Okay.
So you won't have that much rental income because depreciation can kind of bring down that rental income. So it's actually not, it's generally a good idea to buy in a corporation, assuming you already have a business that's incorporated, and you have all this excess money. Otherwise, if you don't have a corporation, you don't have a business, and you're just buying a rental property, but you decide to buy it in a corporation, that's not always a good idea.
Mhm. What makes it not a good idea from a tax standpoint?
When you fully pull out all the money, you're paying more tax in a corporation than
Oh,
personally
yeah.
for most provinces. Right now, corporations will pay higher tax on capital gains than someone who owns something individually.
Mhm.
So there's also kind of that aspect to keep in mind, especially on the first 250,000 of
Yeah.
capital gain. So those are the main two reasons. And then it just cost complexity. There's people I've been working with. I spend hours explaining how corporations work, and things still don't necessarily make sense to them. Complexity isn't always fun, and
Mhm.
people love the idea of a tax savings vehicle, but when it comes to actually understanding and all the administration and costs with handling a corporation, oftentimes it doesn't really make sense, even if
Yeah.
benefits are there.
Yeah, yeah, yeah. I like it. If you save 10K more a year for having a corporation, but now you're racking your head with more reporting and more dilemmas on paying yourself, things like that. Is that 10K really worth the hassle? It all depends,
Exactly.
right? 10K is nothing to sneeze at, but on the other hand, if you're a doctor making 450K a year, 10K is nothing. Have you dealt with any clients with cryptocurrencies?
Big
Yeah.
topic right now.
And
Uh,
how does taxation on cryptocurrencies work? Is it considered an asset or a currency?
Good question. I think it depends on how you use it. For most people who invest in crypto, it's like an asset or property or whatever the case is. So if you buy it with the intention, of selling it in the future for more, it's typically a capital gain, according to this current view. In some cases, you might be considered to have kind of a crypto business, in which case the income is actually business income. The biggest thing is the nature of your crypto. Is it for investment purposes or day trading? How is it really being used?
I was curious because I know that the US and Canada have like two different ways of viewing cryptocurrency, but I'm not entirely sure myself. I don't have any clients yet who own cryptocurrency. I have had a handful who have said they would be interested in it. I'm not a fan of that concept. I don't mean as a concept, I mean as just a asset and a potential strategy for investment. But yeah, so definitely you will be my point of contact where I will send them.
No worries. Crypto gets difficult because, there's so many different things, and it's even from, for me, at a point I started investing in crypto and doing these different other things that you could do with crypto, staking, all these sort of things, just so I can be aware of how they work and how it
Mhm.
is so I can properly advise people, right? So I didn't put a lot of amount, but I just like people are bringing this up to me and I need to kind of make sure I understand how it works.
Yeah.
And what you find is, in some cases you can really get screwed over if money gets embezzled. It's not like there's an automatic ability to claim a loss, right? Or if crypto goes worthless, it doesn't mean you can automatically claim a loss. Versus something like a stock, if you invest in a stock, and not saying you should invest in individual stocks or anything, but
Hashtag not
uh
investment advice.
but if a stock goes worthless, there's actually elections that you can make to claim a loss on it. So I think there's a lot of traps in crypto that,
Mhm.
the general population might not be aware of. It's something you should be mindful of before you kind of engage in it, before you do really risky things
Mhm.
with crypto.
And then you can't, not all the time can you claim that as a as a capital loss, right? I had a question. Okay, can you, because the whole idea I understood is that when, let's say, you own a share, let's say you own a stock in something, and that goes to zero, can you still claim it even if you didn't sell it?
So the general rule says you have a capital gain or loss when there's a disposition, and you don't have a disposition unless you sell it. Generally, you need to actually sell it. Now there is an election called a 50 sub one. If your stock becomes worthless, you can make this election and claim a capital loss on it. It says it's only available for stocks and loans, so presumably that would include bonds.
Bonds?
It doesn't say crypto, right? For crypto, if something goes worthless, you still need to sell it. And it's not like, and if it goes to zero, it's not like there's a market buying and selling for it, right? There might be no buyers and you might be stuck with it. Unless you can sell it in a real transaction, you may not be able to claim a loss on it.
Wow. Another one is, I think I saw you write a thread a year ago. I think you wrote about, let's say, a business owner, let's say a sole proprietor sells their business, but they're not incorporated, so they're not doing a share sale. Therefore, are they technically ineligible for a lifetime capital gains exemption? But I think you mentioned there is a way around that.
Yeah, there is. So one of the big requirements so lifetime capital gains exemption lets you sell your business tax free. Your business has to be incorporated and you had to have owned it. Generally, you had to have owned it. The rules are simplified for at least 24 months, right?
2 years
And
or
so
something.
exactly, two
Mhm.
years. Some people get scared when they hear that and they're not incorporated. I had a person who built interesting crypto software, and he was about to sell it, and he's like, "Yeah, is there a better way to sell this? Because I can't claim the lifetime capital gains exemption." And I said, "You potentially could," and he was kind of shocked about that, right? So he was about to go and engage in a sale. He wasn't kind of getting any professional advice. It was just informal, and he was about to sell it, and he was going to incur all this tax. And hold on, there's some planning here, it can exist. And basically, there's this rule that basically says if you incorporate a new corporation and transfer everything before the sale, you're deemed to own it for the past 24 months. When I told him about that, he went from potentially paying hundreds of thousands in tax to nothing. So he was a big
Mhm.
shock to people. But it is something to keep in mind whenever you're selling a business. Tell your planner, tell your accountant, even if the lifetime capital gains exemption isn't available, there's other things that could be available when you're selling your business.
Wow. Okay. Sometimes people need guidance when it comes to taxes, but also the valuation of that business, the asset
Mhm.
itself. How can you sell that business in a way that's more tax efficient?
What to do with your
Yeah,
souls.
exactly. There's tons of advice that accountants, advisors, planners, and consultants like business brokers should definitely be asked before you make your choice.
There's this person who specializes in M&A law or buying a business, and he tells me about the horror stories he's heard with people buying a business without getting professional advice. So yeah, only 100% agreed. You need professional advice. Professional advice matters when you don't realize, like you only realize the value of it after the fact.
Yeah.
After the fact that you didn't use it, right?
Let's say you're in any given country and you have a mutual fund or ETF, right? Chances are that the holdings for the country in which you live in which that thing is being created, sold, and managed is higher than it actually makes up in the global market. In the US, most people don't have international exposure. It's like 100% American. Canada, there are people who have 80% Canadian stocks, a Canadian exposure. We need to bring that down. Vanguard has about a 20% exposure to Canada. So in their all equity ETF, their exposure to Canada is like 20%. But Canada only makes 3% more, give or take between 2 and 3% of the global stock exchange. If you're taking above a certain amount, you have to feel comfortable. Canada is heavily concentrated in financials and in mining and petroleum, gets a hit in commodities, then you're gonna then that's gonna be a real hit. If 60% of your portfolio is Canadian, That's a big problem. In this case, you already buy a lot of these other things. You have a pension and a defined benefit pension. You might as well, when you have the option, if you can diverse away from Canada, you might as well do that. That way, you're because this is not an RRSP even. This is a non-reg account. So if there's a crisis, he loses his job, gets laid off, he can now go to his non-reg as a source of survival, right? If it's all concentrated in Canada, it
Mm,
would be down when he needs it most. That's why you should diversify away from Canada. Yeah, yeah. I know one gentleman in the tech sector, very well paid, and he invests. He does a lot of DIY and a lot in tech companies. I said, I understand you're not making a big mistake, but are you aware that if you lose your job because there's a downturn in tech and then you need your money to survive your investments to, let's say, make it, now those investments are down as well when you needed it the most. So should you not consider lowering your exposure to tech because already your human capital is so dependent on tech? So that's
that's the typical mistake. People invest in what they know, right? They don't diversify from their own industry, which is always a risk.
it can be a good thing. Companies issue RSUs because employees who own stock tend to stick around longer, tend to, if I remember correctly, tend to have higher output of productivity, and they're less likely to sell. At a downturn, it's like because they're so emotionally attached to that company. On the other hand, for that worker, they're also assuming a risk as well. They may not sell when they probably should. They also may not sell when they probably shouldn't. They're kept in the game longer. With some people, is because they know their economy, they feel part of their economy, and they have a pride in their economy. There's a reason why we see McDonald's has a Canadian, maple leaf in it. There's a reason why there's all these brands and companies that talk about made in Canada or Canadian beef or Canadian sourced materials, etc. It's because we have an attachment to our country. So that also extends to investments, and that may keep us more, invested when there's a downturn, when we think we should be selling. It's up to an advisor to help a client understand, present an objective viewpoint on a asset, and let them know the pros and cons, and help them make a decision.
Yeah, I think that's good analysis.
Ah,
I'm very impressed.